What do dividends, share buybacks, and a single four-word concept have in common? They determine whether your long-term gains are real, or just an illusion grocery-bagged as performance. In this video, we'll translate Benjamin Graham's chapters on dividend policy and the margin of safety into plain, usable rules. You'll learn how to judge whether management is actually returning value to shareholders, how to spot when a payout is a mirage, and why the margin of safety is the single idea you should tattoo to your investment checklist. Chapters 19 and 20 are the moral center of the intelligent investor. Chapter 19 forces you to question what companies do with cash, dividends, share repurchases, employee options, and whose interests those actions really serve. Chapter 20 gives you Graham's career-long thesis in one tidy practical concept: the margin of safety. Get these right and you protect yourself from the market's fashions. Get them wrong and you'll discover how quickly a winning stock can turn your savings into regret. I'll give you checklists, red flags, and specific screens you can use the next time you read a company report. A dividend is the clearest signal a company can send. Here's cash, straight to owners. But Graham warns that not all payouts are created equal. A dollar paid as a sustainable dividend usually helps the shareholder more reliably than a dollar retained and supposedly invested for growth. In many historical examples, a paid dollar had a far stronger positive effect on market value than an undistributed dollar. That's not because retained dollars are useless. It's because managers can squander retained capital or invest it poorly. Analytical studies Graham cites show that, in many typical cases, a dollar paid out in dividends had multiple times more positive effect on share price than a dollar of undistributed earnings. Why? Market psychology, sure, but also economics. Dividends are real cash you own. Retained earnings are claims on management's ability to allocate capital well. For ordinary investors, the safer bet is real cash in your pocket, unless there's a highly credible plan for reinvestment. Graham wrote before the era of massive buybacks and option-heavy executive pay, but his concerns translate. Today, many companies prefer buybacks to dividends, and managers often like buybacks because they can boost EPS and option value without the recurring commitment a dividend represents. That can create conflicts. Buybacks can help insiders with large option grants more than they help long-term shareholders, especially if the buybacks happen at high prices. If management favors buybacks over dividends, ask why, and check whether the buybacks actually reduced shares outstanding or simply shunted cash into financial engineering. Here are the big warning signs Graham wants investors to notice. Payouts funded by asset sales. Selling the crown jewels to pay dividends is not sustainable. If dividends come from one-time asset sales, treat the payout as non-recurring. Buying back stock at high prices. Repurchases at peak prices are wealth transfers from remaining shareholders to sellers, not value creation. Heavy insider option incentives. When management's pay is mostly options, watch for decisions that boost short-term price volatility, good for options, but may not build long-term value. Inconsistency in dividend policy. Sudden initiation, termination, or weird lump sum special dividends often suggest the payout isn't rooted in repeatable cash generation. When you read a company's payout, run this quick audit. Source check. Is the dividend or buyback paid from operating cash flow or from asset sales, debt? Use cash flow statements. Sustainability check. Has the firm generated the cash consistently over several years? Look for multi-year operating cash flow stability. Alignment check. Do management incentives, options, bonuses align with long-term shareholder returns? Or are they structured to reward short-term price spikes? Look at executive compensation in proxy statements. If any step fails, treat the payout as suspect. Not automatically bad, but suspect. Graham's bottom-line advice for investors is simple. Prefer firms that consistently pay dividends from earnings and cash flow. Be skeptical of creative distributions, high repurchases plus rising leverage, special dividends funded by one-offs. When management retains earnings, demand clarity. What projects get funded? What returns are expected? And why is this better than paying a dividend? If the answers are vague, prefer the dividend. If Chapter 19 is about how companies treat cash, Chapter 20 is about how you should value cash, businesses, and the claims you buy. Graham's margin of safety is elegantly simple. Buy with a buffer. Buy $1 of value for significantly less than $1 in price. That buffer protects you from errors in analysis, unforeseen business shocks, and the inevitable unpredictability of the future. It's the single overarching rule of Graham's investment philosophy. Graham's point is probabilistic. Even the best analysis can be wrong. Economies can shift, management can blunder, and accounting can hide problems. The margin of safety reduces the downside, so that when the unexpected happens, your loss is limited. Imagine two scenarios, one where you pay full price for a great company, and another where you pay half price for the same business. If a negative shock reduces value by 30%, the first investor could lose massively. The second may still be solid. The margin of safety is insurance, cheap, powerful, and underused. Graham doesn't give a single formula for intrinsic value. He favors conservative arithmetic. Here's a simple conservative protocol you can use. Start with normalized earnings, average earnings over several years, strip one-offs. See our earlier EPS checklist. Apply a conservative multiple. Use a modest PE or earnings yield that makes sense for the business. Lower for uncertain cyclical businesses. Value tangible assets. For asset-heavy firms, compute conservative liquidation or asset values, net current assets, tangible book. Choose the most conservative of these approaches, and then demand a significant discount between that conservative value and the market price. That discount is your margin of safety. Example A. A stable utility. Normalize earnings over 5 years. Use a low conservative multiple, say 10x, and value the business accordingly. If the market price implies 15x, there's no margin. Walk away. Example B. An asset-rich company trading below net current asset value. The market price is less than the company's liquid assets. That's an obvious margin. Study reasons why, debt, litigation, and buy only when you understand the downside. These are the classic net-net opportunities Graham loved. Buying with a margin of safety forces humility. It says, I may be wrong, so I'll build a cushion. That attitude helps you stay rational when Mr. Market rages or whoops, and it prevents overconfidence from turning into catastrophic losses. Graham's greatest legacy is behavioral. Systematize skepticism so emotion doesn't turn your portfolio into a gamble. Here's a compact checklist to make margin of safety operational. Never buy full price for uncertain forecasts. If a valuation relies on heroic growth, demand a larger discount. Prefer conservative valuation methods. Use earnings averages, tangible asset checks, and conservative multiples. Then take the lowest estimate as your baseline. Size positions to reflect confidence. Bigger margins, bigger positions, thin margins, small positions, or no position. Reassess after new information. If your margin shrinks because the price rises, rebalance or trim. If it widens on price drops and fundamentals hold, consider adding. Treat payouts as signals, not just numbers. Dividends and buybacks can reveal management priorities. Prefer payouts sourced from recurring cash flow. Beware of payout engineering. Buybacks timed to inflate EPS or large option grants that reward insiders are red flags. Dig into proxy statements. Margin of safety is the single most important rule. Buy conservatively, use conservative valuations, and demand a meaningful discount to protect against being wrong. Size positions to reflect margin and confidence. The margin isn't just a number. It dictates how much money you should risk. Use a 3-step audit on payouts and a conservative valuation protocol on every potential buy. They're fast, teach discipline, and save your capital. Which of these rules do you want to try first? The 3-step payout audit or the margin of safety valuation protocol? Drop a comment with one ticker, or margin, if you want the valuation worksheet, and I'll pick a few to analyze in a follow-up video. I read and reply to comments. If this helped, like and subscribe. Next video, I'll take 2 real companies from your comments and run the payout audit and margin of safety valuation live, line by line. Say analyze and drop the tickers below. If you want the quick 1-page payout audit plus margin worksheet, type worksheet in the comments, and I'll add it to the description. Thanks for watching. See you in the next video.